Hi everyone. Markets are currently struggling with high inflation and fears of a possible recession in the US. Interest rate hikes by Fed and other central banks around the world led to a significant selling by FIIs in the Indian market, reflecting a lack of confidence in future demand growth. Amidst the selling by FIIs, small cap stocks have taken a much bigger hit in comparison to the large cap stocks. A large number of small cap stocks have seen correction in valuation on back of earnings downgrades as well. However, amongst this turbulence in the small cap space, there usually arises an opportunity of investing in stocks that have seen earnings upgrades yet have fallen in valuation. We at Sher Khan Education have researched two such small cap stocks in the logistics space that have potential to give good returns in the future. The first stock we have researched is VRL Logistics. VRL provides less than truckload services for general and priority parcels and caters to industries such as fast-moving consumer goods, FMCG, textiles, apparel, furniture, metal products, and automotive parts. Goods transport contributes to 89% of the business, followed by passenger bus service, which contributes 7%. It operates 4,816 trucks across 956 locations and 295 passenger bus service across 7 states in Tier 1 and Tier 2 cities. The goods transportation fleet is a wide range of vehicles with carrying capacity from 1 ton to 36 tons. The asset-owned model enables VRL to control operational costs, get a higher payload per vehicle for LTL consignment, cover higher routes, and reduce dependence on the third-party hired vehicles. The model also enables better control and time-bound delivery. In FY22, VRL added 91 new branches and 241 new vehicles, including 19 new electric vehicles. Bus operations turned EBITDA positive on the back of increased occupancy and realizations. It also concluded sales of its wind power undertaking and aircraft. VRL's strategy for growth includes expansion into North, Northeastern, and Western regions, addition of 100 branches in the untapped regions during FY23 after adding 91 in FY22, capital expenditure of Rs 5 billion for the next 2 years wherein fleet may expand by 20% plus, increase tonnage and operating kilometers of own vehicles, and garner higher freight volumes and maintaining business operations. The company has also chalked out various strategies to reduce costs, such as procurement of fuel directly from refineries and private petroleum companies, usage of biofuel, about 6% of total fuel consumption in FY22, usage of RFID tags to monitor real-time fuel usage, dedicated in-house maintenance and vehicle body design facilities, genuine spare parts procurement at competitive rates, and focus on retaining experienced drivers. By FY23, the logistics industry will see the benefits of the shift from unorganized to organized players. Reforms like GST and e-way bill are benefiting big players like VRL and are expected to increase share of LTL against FTL full truckload. Demand for faster transportation would see higher deployment of LTL services, unlike the traditional approach of waiting for FTL to deliver. The company's strategies will enable it to grow its revenue by 24.8% and 16% over the next 2 years, and profit after tax to grow by 10% each over the next 2 years. While margins are expected to get adversely impacted by this year, the return ratios are more than 20% and expected to go above 30% after 2 years. Earnings growth and ROCE expansion can lead to re-rating in its valuation. The stock currently trades at 21.4 times FY23 estimated EPS of Rs 32.8. The second stock to look at is TCI Express. TCI is a leading time-definite express distributor with a network of 700 offices covering more than 40,000 locations. TCI has over 3,000 plus workforce with 28 sorting centers. It offers services such as surface domestic and international air, e-commerce, priority and reverse express services. TCI Express caters to sectors such as consumer electronics, retail, apparel and lifestyle, automobile, pharmaceuticals, engineering, e-commerce, energy power, and telecommunications. TCI has a 5% value market share in the organized segment and is expected to be the biggest beneficiary of the shift from the unorganized to the organized players. TCI's growth outlook remains strong with an expectation of 20 to 22% growth on the back of strong pent-up demand from the SME segment, which comprises 50% of revenue. Volumes are expected to grow by 16% year-on-year. Higher capacity utilization and cost efficiencies. Higher utilization and cost efficiencies would improve margins by 50 to 100 bps to 17.4%. The company has launched 3 new products: Cold Chain Express, catering to pharma and frozen foods packaging companies; C2C Express, which is first to launch customer-to-customer service with multi-location pickup and delivery; and Rail Express, which will cater to B2B air cargo business. The management is optimistic about recovery and expects to gain market share. TCI added 45 branches in FY22 and is expected to add another 100 in FY23. It would double its number of branches in 3 to 4 years. Over the last 2 years, it has added 10,000 customers, taking its total customers to 2.2 lakh. It had also taken a 2.5% price hike in FY22, and it expects to take a further 4 to 5% price hikes in FY23. To propel its growth in future, it spent Rs 80 crores towards capex for FY22 and plans Rs 100 crore capex for FY23. The logistics industry has seen a strong revival post-COVID, aided by improving domestic indicators such as e-way generations, FASTag collections, Indian rail volumes, domestic port volumes, and foreign trade. The third-party logistics 3PL industry has seen faster improvement in operations, led by segments such as e-commerce, pharmaceuticals, and FMCG. TCI will capitalize on improving infrastructure, national logistics policy, and GST to post strong earnings growth over FY22 to FY24. Further, TCI has strong balance sheet of over Rs 100 crore and it expects cash generation of Rs 175 to 200 crores during FY23, which would be more than enough for Rs 100 crore capex and Rs 75 crore stock buyback for FY23. The stock trades at 34 times FY23 estimated EPS of Rs 43.3 and trades near average valuation on the valuation band. Investors who are looking to invest in these stocks should keep these companies on their radar. Further, they should do their own research and analysis on these stocks and enter accordingly. This is VRL Shah signing off. Happy investing. This should not be treated as a recommendation. Please conduct your own analysis or consult a financial advisor before investing.